Prudential norm means liquidity and solvency norm for the commercial banks contained in the core capital for effective banking supervision. The Government of India appointed the Narasimhan Committee in 1991 to suggest reform in the financial sector. So that is Narasimhan Committee Report 1, Capital Adequacy Norm. So first is Tier 1 Capital, Tier 2 Capital, Risk-Weighted Asset and Subordinated Debt. Hello everyone, a warm welcome to one and all to the second session on Unit 3, Law and Practice of Banking. I am Meghana from the Department of Commerce, lecturing in Vidhyaashram First Grade College, the Temple of Excellence. In today's session, let us discuss with the Banking Regulation Act 1949. So let us start with today's session. Let us continue with the Narasimhan Committee Report 2, Prudential Norm, Capital Adequacy Norms, Non-Performing Assets, Measures to Reduce the NPA. So let us discuss one by one. So in the last session, we have discussed about the Narasimhan Committee Report 1. So under Narasimhan Committee Report 1, they submitted their recommendation and government takes some measures in order to improve, in order to strengthen the banking sector in India. So under Narasimhan Committee Report in the year 1998, the government appointed yet another member in order to submit the report in order to improve the banking sector, again with the chairmanship of Narasimhan. Again with the chairmanship of Narasimhan. Under this chairmanship of Mr. Narasimhan, it is better known as the Banking Sector Committee. It is also known as the Banking Sector Committee. So it was told to review the banking reform progress and to design a program for further strengthening. In order to review and in order to improve, in order to better the strengthening of banking sector in India as well as the financial system. The committee focused on the various areas such as capital adequacy. So under Narasimhan Committee report, they focus on the capital adequacy, then banker merger and bank legislation, etc. So under committee report 2, they focus on this factors. So again, they submitted their report in April 1998. April 1998, they submitted Narasimhan Committee Report 2 with some recommendation. So what all are those recommendations? So under Narasimhan Committee Report 2, they suggested or they recommended to strengthening the banks in India. So they suggest to strengthen the banking system. So that means current account convertibility, and the bank should be able to manage the domestic liquidity, then exchange rate. So Indian bank should be able to manage their domestic liquidity as well as the exchange rate, current account convertibility. So through all these things, so we can strengthen the Indian banking system. So in order to strengthen the banking system, in order to ensure all these factors, we will go for the merging. So merging with the stronger banking system, merging with the stronger bank helps to improve, helps to strengthen the banking system in India. So they suggested merger. They suggested merging activity in order to strengthen the banking system in India. So that is first thing. Next suggestion, second one is narrow banking. In those days, non-performing assets were high. So in order to reduce the non-performing assets, Narasimhan Committee Report 2 suggested for the narrow banking concept. So under narrow banking concept, banks, they are going to invest, they are going to spend their capital only on the short-term period as well as for the risk-free asset. So the non-performing assets, the ratio of non-performing assets will come down. So those days, the non-performing assets ratio asset was 20%. So it is high. So in order to reduce that non-performing asset ratio, so they come up with the narrow banking concept. So under narrow banking concept, they are going to invest on the risk-free asset as well as for the short-term period. So it helps to reduce the non-performing assets, it helps to recover their debts easily, so that they come up with this narrow banking concept. Next one, capital adequacy ratio. So So under capital adequacy ratio, they suggested in order to improve the banking system, the prescribed capital adequacy ratio, you need to increase the capital adequacy ratio up to 9% so that it helps to strengthen your banking system. So now the current capital adequacy ratio is 9%. So initially, Narasimhan committee report, they suggested to raise capital adequacy ratio at 8%. So now they suggested to increase phase by phase. So they suggested to increase at 9%, then later 10%. So now the current capital adequacy ratio is 9%. Next, bank ownership. Under bank ownership, government tries to control the banking system in India. This will not go in hand, so that in order to observe, in order to review the banking system, you need to allow to adopt for the corporate strategy, professional corporate strategy. So initially it is governed by, it is controlled by the government of India, so that it is difficult to review and to adopt for the strategy. So now they suggested in order to adopt the corporate strategy, professional corporate strategy, in order to review the functions of banking system. Next one, last thing, review of banking laws. So they suggested to improve, to amend the banking law, Banking Regulation Act, RBI Act, then State Bank of India Act, all those acts. So there is necessary in order to amend those acts, review the acts, it is required to amend those laws for the betterment, to improvement. So these all are the suggestion or recommendation under Narasimhan committee report 2. So they recommended for the government, they submit their report in April 1998 with all this recommendation. So this is all about Narasimhan committee report 2. So moving further, next topic is prudential norm. Prudential norm means liquidity and solvency norm for the commercial banks contained in the core capital for effective banking supervision. So liquidity and solvency norm. It is a liquidity and solvency norm for the commercial bank. Liquid cash in order to meet the expenses, in order to meet uncertain risk. Then solvency position, solvency norm, solvency position for the commercial bank. So commercial bank, they lend money for their customer. So the solvency position or solvency ratio from those lending purpose. So all this we call it as a prudential norm. So as published by Basel Committee on Banking Supervision in October 2006 and revised from time to time. So prudential norm means according to this Basel Committee on the banking supervision, they submitted on October 2006. According to this, prudential norm means liquidity and solvency position for the commercial banks. Solvency and asset coverage norm for the insurance companies contained in the insurance core principle and methodology as adopted by the International Association of Insurance Supervisors in October 2003 and revised from time to time. So asset solvency and asset coverage norm for the insurance companies. So it is contained by the insurance core principles and methodology. So this is all about prudential norm. Basically, prudential norm means solvency and liquidity position for the commercial banks. In line with the international practice and as per the recommendation made by the Committee on Financial System, Chairman Shri M. Narasimhan, the Reserve Bank of India has introduced in phased manner prudential norm for the income recognition. They introduced the recommendation of Narasimhan committee. They introduced phased manner. They introduced in a phased manner in order to improve prudential norm for the income recognition. Prudential norm for income recognition, asset classification and provisioning for the advances portfolio of the banks. So has to move towards greater consistency and transparency in the published accounts. They took some action in order to improve the prudential norm, in order to improve the solvency ratio and liquidity ratio for the commercial banks. So they introduced in a phased manner. They consider as income recognition, asset classification, then provision for the advanced portfolio. They took some action in order to improve this prudential norm. Moving further, capital adequacy ratio. The government of India appointed the Narasimhan Committee in 1991 to suggest reform in the financial sector. So that is Narasimhan Committee Report 1. So while discussing about the Narasimhan Committee report, we have discussed about this. So government of India appointed Narasimhan Committee in order to submit their report, in order to improve, in order to strengthen the banking sector for the banking reforms in India. In the year 1992-1993, the Narasimhan Committee submitted its first report and recommended that all the banks are required to have a minimum capital of 8% to risk-weighted assets of the bank. So while discussing about Narasimhan Committee report, we have discussed that. So they suggested that capital adequacy ratio should be at 8% to the risk-weighted assets of the bank. So under Narasimhan Committee Report 1, they suggested capital adequacy ratio at 8%. Then later, the ratio is known as capital to risk asset ratio. The ratio is known as capital to risk asset ratio. Capital adequacy ratio is also known as capital to risk asset ratio. Next, all the 27 public sector bank in India except UCO and Indian Bank had achieved this capital adequacy norms 8%. So, according to the Narasimhan Committee Report 1, they suggested that capital adequacy ratio should be at 8%. They achieved, all the 27 public sector bank, they achieved to raise or to increase the capital adequacy ratio of 8%. So, except from this UCO and Indian Bank. The second report recommended that CRAR to be raised at 8%. It is in a phased manner. First at 9%, then increase it to 10% by 2002. Then the government increased the capital adequacy ratio to 9%, then later at 10%. This capital adequacy ratio, it can be explained through one diagram. Concepts of capital adequacy norm. So first is tier 1 capital, tier 2 capital, risk weighted asset and subordinated debt. So let us discuss one by one. So under that first one is Tier 1 capital. Tier 1 capital is a capital readily available, firstly available in order to meet uncertain losses. In order to meet uncertain losses. This Tier 1 capital includes paid up capital, statutory ratio, other disclosed reserve, then capital reserve. So all this comes under the Tier 1 capital. So next one is Tier 2 capital. Tier 2 capital is secondly available in order to meet the uncertain losses. Secondly available capital in order to meet uncertain losses. This Tier 2 capital includes undisclosed reserve, then revaluation reserve, then debt equity reserve. So all this comes under the Tier 2 capital. But the main condition for this Tier 2 capital is the Tier 2 capital, the percentage of Tier 2 capital should be less than 50% of Tier 1 capital. Example, Tier 1 capital is 10 lakh rupees means Tier 2 capital should be less than this 10 lakh rupees. That means it should be 4 lakh or up to 5 lakh, less than 5 lakh rupees. So that is the main condition under Tier 2 capital. Third one is risk weighted asset. So risk weighted assets, under this method, in order to evaluate the risk weighted rate, in order to evaluate the value of asset, we consider the value of bank assets. So, in order to consider the overall value of the bank assets, we don't consider the book value. Each asset is considered with their respective loss, respective risk factor. So, we consider the risk factor in order to take the value of asset. So that we don't consider the book value, we consider risk weighted asset in order to calculate the capital adequacy ratio. While calculating capital adequacy ratio, we need to take the asset value of the bank, so that we consider risk factor for the asset, risk weighted asset value for the calculation purpose. Next one is subordinated debt. So it includes, there should be a fully paid up capital and there should be a unsecured debt. So all these things comes under the subordinated debt. So this is all about the capital adequacy norms and capital adequacy ratio. Moving further, non-performing asset. Non-performing asset refers to a classification of loans or advances that are in default or in arrears. Non-performing asset means default or in arrears. For example, banker lends money for their customer. If the customer fails to repay the principal and interest, then automatically he become non-performing, or while classifying the asset, we consider that debt as a non-performing asset. So debtor is an asset. So we consider this debtor, the default debtor, as a non-performing asset. So this information should be mentioned in the balance sheet. So performing asset and non-performing asset. So while considering or while declaring the performing and non-performing assets, we need to consider if the debtor fails to pay principal and interest for a particular month. So we consider that as a non-performing asset. So non-performing assets listed on the balance sheet of bank or any other financial institution. While declaring or while mentioning the assets, they need to mention this non-performing asset. After a prolonged period of non-payment, the lender will force to borrower to liquidate any assets that were pledged as a part of the debt agreement. That means after a fixed period, after a prolonged period, the borrower forced to accept this pledge documents. That means the pledge document, the banker has the right to sell or to utilize that pledge documents in order to recover that debt. If the debtor have not submitted any documents, they will go for private agency on a discount basis for the collection purpose. So that is non-performing asset. What all are the factors? Next, factors contributing for the NPA. What all are the factors? First one is diversification of funds. So diversification of fund is a main thing which contributes for NPA. When you are diversifying your funds, there is a chance of increasing in non-performing asset. Next one, business failure, internal factors. Usually customer, they borrow money in order to start business or in order to meet their expenses. So the main thing is in order to start business. If the business fails to activate, if the business fails to sustain in the market, then there is a chance for this non-performing assets. So all the money is invested on business. Now customer fails to success or customer fails to exist or retain their business, so that he cannot repay the money along with the interest. So due to internal factors, if the business fails to operate, then it contributes for increasing NPA. In a similar way, external factors. So business failure due to external factor will lead to increase in NPA. Either it may be internal, it may be in external factors, but it contributes for the NPA, increase in NPA. Last one is banks being responsible for NPA. Bank is a sole responsible for this NPA because they need to check their background, their repayment capacity, then they should accept or then they should approve their loan. So bank has the responsibility to check the repayable capacity, then approve the loan. So that banker has the responsibility. Bank is a sole responsible for increase in NPA. So this all about the factors contributing NPA. Next, last topic, how you can reduce this NPA or measures to reduce this NPA. So under that, first one is a debt recovery tribunals. Through the debt recovery tribunal, you can recover the debts. You can recover the debts and you can reduce this NPA. Next one is Lok Adalat. So according to Lok Adalat, small finance or small loans can be recovered from this Lok Adalat. That means up to 5 lakh rupees. Small finance or small loan up to 5 lakh rupees you can recover from this Lok Adalat. Next one is compromise settlement. Compromise between the banker and customer. Through compromise, you can settle your debt. You can reduce the NPA. Compromise is one of the factor or one of the measure in order to reduce the NPA. Next one, Credit Information Bureau. Under Credit Information Bureau, CIBIL, it's a private collection agency. They will give all the detailed information about the default customer, so that they take a action, they take a measure in order to collect, in order to recover the debt, in order to recover the debts from customer. So for this private agency, they give detailed information about this default customer. So last one, SARFAESI Act 2002. SARFAESI Act 2002, according to this act, they give three options in order to reduce NPA. So first one is asset reconstruction, second one is security enforcement, and last one is securitization. So through this three options, you can reduce the NPA, you can reduce or you can recover the debts. So this SARFAESI Act 2002 give three options in order to recover your debts and in order to reduce the NPA. So through all this form, you can reduce the NPA, or these are the measures to avoid or to reduce the non-performing assets. So all this factor helps to increase the efficiency. It helps to contribute for the banking sector, the development in the banking sector. This is all about Unit 3, Banking Regulation Act 1949. So for this topic, we finished with the Unit 3. So in the next session, let us meet with the Unit 4. Until then, keep watching. Thank you.